Good afternoon, everyone, and welcome to another session in our Corporate Access webinar series. I'm Sharna K. Stewart, AVP Business Analytics Strategy and Portfolio Advisory at Scotia Investments, and I will be your moderator for today's session. The COVID-19 pandemic has presented one of the most profound challenges to the global capital markets in recent memory. How have the markets responded, and what role will they play in the recovery effort? Joining us today to provide insight into this topic are Sarah Cumming, Juan Folowando, and Carlos Garcia. Sarah joined Scotiabank in April 2020 as Vice President of Capital Markets, and in this role, Sarah is responsible for developing the strategic direction of the unit while leading client coverage, origination, structuring, and execution of innovative structured solutions. Sarah has 10 years of international corporate and investment banking experience, covering top-tier corporates in the power, telecom, and consumer-branded industries. Throughout her career, Sarah has been recognized as a talent with strong partnerships who collaborates well across boundaries to deliver seamless execution of transactions. Juan Folowando is Managing Director and Head of Debt Capital Markets Latin America. In this role, he leads a team of professionals who advise on and execute bond offerings on behalf of corporate clients, sovereign and quasi-sovereign entities in Latin America and the Caribbean. He has over 25 years' experience in banking and capital markets. He has a strong track record of success and trusted client relationships, and has achieved top rankings in the LATAM space, in the current role as well as in his former role in a leading global bank. Carlos Garcia is Director, Debt Capital Markets, Latin America. He's responsible for originating, structuring, and executing bond mandates for sovereign, quasi-sovereign, and corporates in the Latin American Caribbean space. He has over 10 years' experience in debt capital markets, credit analysis, and execution, having held successively senior roles in the debt capital markets team throughout his career. Sarah, Carlos, and Juan, thank you so much for joining us. Before we start, I'll just run through a few quick housekeeping matters and just explain the flow of today's session. So we'll start off with a presentation by Carlos and Sarah, and they'll be looking at how the cap markets have performed globally, domestically, in response to the coronavirus crisis, and the role that they will play in the recovery process. In the presentation, Carlos will be taking us through a few case studies in which he will highlight how the markets are performing recently. Following the presentation, we'll have a conversation, a panel discussion with Carlos, Juan, and Sarah, where we will seek deeper insight into what has transpired and the prospects for the market going forward. We'd also like to hear from you, our audience, so we'll open up the questions at the end of the panel discussion, and we will respond to your questions and comments. So in order to ask a question, we'll ask you to type in the chat box associated with this meeting. Please ensure that the word everyone is selected in the drop-down beside the to button, and please use the chat box to everyone for your questions. I will now invite Sarah and Carlos to make their presentation.
Perfect. So I think it's my turn to start. First of all, thank you very much for everyone to join and for your time. I think what we wanted to do is start with a little update on the capital markets, so you have a sense on how it has been evolving during this year. If you can go to next slide, please. I think the key messages in this slide are the following. First of all, year-to-date volume exceed $90 billion versus the same period last year, where we only had 66%. That represents an increase of 33%. If you look at the chart at the bottom, when you see the red line, you will see how it has been progressing. It was a very strong start of the year, and then for February, March, and April, it was very stable. But after the coronavirus started, we have seen many of the sovereign, quasi-sovereigns, and corporates coming back to the market, issuing a lot of money again. So you see that from January, February, you had around $40 billion of issuance, and the last couple of months, you have seen that volume increasing significantly for 50 billion plus. And as you can see on the left side of the slide, you will see that there has been a lot of recent transactions, and there's a strong pipeline for transactions to come. Next slide, please. The main purpose of this slide is to showcase a little bit the how and where these transactions have come from. The first one is in terms of geographically diversification. The main countries who have issued both the sovereign, the quasi-sovereigns, and the corporates are Mexico, Chile, and Brazil. These have been specifically from the sovereign side, where they have had to fund. Initially, at the beginning of the year, they fund the budget for the year. We already had a lot of social activities planned for them. But then after the coronavirus came into place, they had to come back for a second time in the year, which is not common. They typically fund themselves for the full year, and they had to fund as much as they had initially funded in the beginning of the year to be able to cover for their funds. Something that is more closer to you is that the Central American and the Caribbean region, if you look at the chart on the right, represents 9% of the total volume this year compared to 13% of last year. We're seeing this a little bit behind than last year, but we know in the pipeline are several sovereign and quasi-sovereign issuers from the Caribbean that have plans to issue in the markets before the end of the year to be able to boost the liquidity for coronavirus preparation. If we go to the bottom left chart, in there you will see the participation by type of issuer. What we have seen this year, and what is always common for this market, is the majority of the volume comes from sovereigns and quasi-sovereigns, which are entities owned by the government. That has been the case here as well. The corporate participation has been also very strong, with 24% of participation. So beyond the typical quasi-sovereign sovereigns, we have seen many corporate issuers to come to market. And the main driver for them to come in this market is they're concerned about the future, and they want to make sure they have strong liquidity to make sure they can cover anything that could happen in the near term. Also, they might have refinancing in the next 12 to 18 months, and they're taking to proactively approach to come to market and take advantage of the strong environment to issue. Next slide, please. In this one, I think we break it down a little bit more by the type of issuers at the top. As you can see, the sovereign and quasi-sovereigns had a very strong of the year, then they stayed a little bit quiet, and then when the coronavirus hit hard, they have come back very hard. It has been the opposite movement that we have in corporates. They started slow, then they increased their volumes. They have been very quiet during the most part of the volatility of the coronavirus, let's say from April to June, but we are starting to see the pickup now. Typically, corporates need a longer lead time to come to market, and that's why you're seeing these two charts, that the sovereigns and sovereigns, they can easily come to market. A couple of weeks after they decide to come to market, the corporates need a little bit more time. That's why you see a little bit of a lag. But we still see many of the corporates on the pipeline that they're interested in funding their needs for the rest of the year. In the bottom part, you will see the breakdown by ratings. Anything above BBB minus represents an investment grade rating. And as you can see in the bottom left chart, you will see that the majority of the issuers are from investment grade countries, or so also ratings. I think that's always the case, and it's more accentuated in years where there are more volatility, like at the beginning of the chart to the left. But we also know that in this situation, there are many sovereign high yield issuers like El Salvador, like Brazil, that they have a lot of funding needs, and they have come to market with a significant size transactions to be able to fund their budget that they have in place. The last chart that I will review before I pass it on to Sarah is related to the maturities. As Sharniki mentioned in the beginning, the capital markets have the benefit of going long term. Like you can go 7, 10, up to 30 years and even more. That's one of the main benefits of the market. And typically, issuers come to this market when they need to provide long tenors. If you look at the breakdown by tenors, you will see that if you add the 10-year and the 30-year tenors, they represent the majority of the issuers. The other tenors are available as well, but I think people, when they come to this market, they try to maximize the tenor and have bullet maturity, which is a benefit in the long term for your capital structure. I'll pass it on now to Sarah so she can go through the next slide.
Okay, just to give a little background and context in terms of our local capital markets, we've enjoyed a robust growth over the last 4 years. In fact, the local capital markets experienced a compound annual growth rate of 66% in issued Jamaican dollar volumes and 8% in US dollar volumes. 2020 was slated to be another record year for local capital markets with a healthy pipeline of transactions, especially in the equity capital markets. So this slide here, what we focused on is looking at the quarter from March to May 2020. And what we've observed is that the volume of issued transactions, both in JMD and USD, have declined. In Jamaican dollars, the volume of issued transactions declined by 56% and USD by 36% when compared to the same quarter, March to May 2019. However, when we look at the value of registered transactions, we are seeing where the value of registered transactions compared to the same period last year has actually increased by 37%. Interestingly, what we also looked at was the proportion of the issuances during the period that were new to market, new issuers, versus what were refinancings. And what we see is that there's a greater proportion of new issuers than there are refinancings. This seems to suggest that the exempt distribution market is still considered an attractive option for new issuers. In terms of outlook, we do know that the volume of XD transactions can be highly influenced by large episodic transactions. My view is that we can expect to see fewer larger transactions this year, but perhaps a more significant volume of smaller deals from new issuers. Next slide, please. Just wanted to touch a little bit on the regulatory impact that COVID has had. So right before COVID, there was an increase of 46% in the administrative threshold for foreign currency placements from 35 million to 50 million. However, at the onset of COVID, the BOJ urged dealers to postpone new issues of foreign currency denominated securities, really in an attempt to minimize foreign currency liquidity disruptions and to allow for conditions to normalize. So currently, when contemplating a foreign currency issuance, regardless of size, all applications do need to be sent to the Ministry of Finance as well as the BOJ before approvals can be in place. So from my perspective, while these adjustments are seen to be transient, the revisions to this will largely rely and depend on how soon normality returns as it relates to our FX markets. Next slide. The equities market, just wanted to touch base quickly on that in terms of our local equities. I think you all would know that pre-COVID, the Jamaican equity market was on a 4-year bull run with growth in trading activity driven by vibrant retail investor appetite. As I mentioned, the pipeline for equity market transactions this year was expected to be very strong. When COVID hit, we saw an indiscriminate sell-off of equities and a general market decline amid fears by investors of the impact that COVID would have not only on economic activity, but the earnings of corporate entities. So portfolio managers during this time have focused more on selection as opposed to overweighting the market, and as such have been repositioning their portfolios to take advantage of fundamentally undervalued stocks. I believe we can expect the market to respond again once we see more earnings releases coming out for the period ended June. Hopefully that will remove some of the financial obscurity. I also expect that we should get clearer and better forward-looking statements from the managements of these companies, which should augur well for investor confidence. In terms of APO and IPO pipelines, what we've seen is that a lot of the offers have been delayed, obviously due to the heightened volatility and reduced market appetite. However, I still believe that there is a market for companies to raise equity, but this is really subject to them having strong fundamentals and a compelling value proposition. I think during this time, size of the issue is also very critical. It's a big consideration. And I think given the reduced appetite, I do see where smaller transactions will have greater success. Next slide. I'm now going to hand over to Carlos just to speak a little bit about some case studies of debt capital market issuances we have seen since the onset of Corona and highlight the relevance for it for us today.
Thank you, Sarah. I think that we wanted to do is highlight 3 case studies to show how issuers have funded themselves after the COVID hit, and also to show a little bit about the liquidity that there is in the market for issuers from different type and different ratings. I think the El Salvador sovereign is a very good example on how the market is feeling comfortable with very low-rated sovereigns. El Salvador is low single B. The rating of Jamaica is better than El Salvador, and they were able to raise $1 billion at a rate of 9.5% with a final maturity of 2052. That's 32 years. So for a single B at 32-year maturity, this is the longest bond that has issued after the coronavirus started for a single bid issuer. And I think what you can see in this case study is that El Salvador's many countries, they're working with the different capital sources to get the money that they need to be able to fund their COVID programs. They were very active working with the multilaterals April and May to be able to get funding through those sources. But the hole that they needed to cover was too big just for the multilaterals to solve. So they had to come to the international markets. We got the demand of $1.7 billion, and we were able to raise $1 billion. Something very different of El Salvador compared to Jamaica is that in Jamaica, you have a very strong local market that the sovereign and many other issuers can fund themselves. El Salvador didn't have the same benefit because it's also a dollarized economy. So after the multilateral came and helped them, the second source of capital for them and the natural one for them is the capital markets. We also did a transaction for them last year, also a long 30-year bond, which was also very successful. So you see the liquidity on the market and the fact that investors are willing to put their money to work for even these lower rated sovereigns. Next slide, please. The next transaction is one which is interesting to study because it's a transaction that is the first corporate transaction where you had 2 currencies. This is Empresas Públicas de Medellín. It's a public utility of the city of Medellín in Colombia. They provide electricity, utility, water utilities. They also have generation. So it's a vertically integrated utility that has presence in Colombia, Chile, Panama. And they came to market because, as we have seen with many of utilities in the region, is that they're having issues with collections on their customers. So for them to make sure they boost their liquidity, they came to the market and raised $750 million. And that would cover the liquidity needs that they would have and any potential capex that they have to do in the next couple of years. They made the decision that they didn't want to delay their capex plan due to the coronavirus because they see this as a transitory event and they want to be able to continue after the fact. What I'd like to highlight here is that we did the transaction for $575 million in dollars. for a maturity of 2039, so it's a long 10-year. But we do it together with a global COP, which is a global Colombian peso bond. The way those bonds work is that it's denominated in Colombian peso, but it's payable in dollars. So every coupon payment, the exchange rate is used to be able to get the payment in dollars. This was the first transaction from the corporate to be able to achieve that, and we got plenty of demand. The transaction was over 3.5 times oversubscribed, and we had over 180 investors that participated in both tranches of the transaction. It's a strong showing that even not so common currencies that are financed in the international market still have access in this market. And next slide, please. This is another example we wanted to highlight. This is more on the oil and gas space. Petrobras is an oil and gas company for Brazil. They're rated high yield, and they have general corporate purposes needs. They have a lot of capex plans this year, and they also want to boost their liquidity for any potential issues that they face. During the last 3 years, Petrobras has not issued new debt. They actually were in the process of delivering, and they started 4 years ago with a debt of $120 billion, and they have been doing a lot of repurchases of bonds because they're trying to improve their capital. They were able to decrease the leverage to half of that. They're around $70 billion of debt. Nevertheless, the coronavirus hit, and they had the need to fund themselves in the international capital markets. The reception was so strong that they were able to raise $3.25 billion in two tranches, one for $1.5 billion and one for $175. The pricing was very attractive despite the rating, and also despite the fact that we have seen one of the main things we have seen as an issue or as a consequence of the coronavirus has been the decrease in oil prices. So despite this, they were able to get a very attractive rate, and this represents the largest quasi-sovereign trade that has been done this year for a high-yield issuer. I think the three case stories that we highlighted are from different countries and different industries. Some of them are more on the corporate side, and more of them are on the sovereign side. But I think the conclusion is that the market is open for many type of issuers and investors that are facing challenges to find investment opportunities are willing to come to the emerging markets to put their money to work. I'll stop here and I'll pass it on to Sharniki so she can continue with the Q&A.
Thank you, Sarah and Juan, for that presentation. So yes, there has been heightened volatility. Yes, there was some retreat from the markets, but it appears that the markets are open for business for those who have very critical projects that they need to get going. And we also saw where, based on the case studies that were presented, sovereigns and corporates have been able to come to the market and finance to be able to obtain funding for their critical projects. We saw where in the instance where there was a significant need arising from the global pandemic, where the multilaterals, the bilaterals could not provide the necessary funding, the market was still open, and entities were able to actually go into the market and seek the funding to address the critical needs arising from COVID. So we're happy about that. So we just want to start our panel discussion. I'm going to kickstart the discussion with Juan. Just want to bring you into the discussion. And having been in the market for some time, I would want to get a sense from you as to how the COVID crisis compares to any other shock to the capital market we would have witnessed in the past. What are the key takeaways that we should take from this current crisis relative to the others that we have seen?
Thank you very much. I remember on March when the crisis started, I told all of the guys that work with me, listen, I think we're going to be having no issuances for the next 4 to 5 months. In reality, I thought that it was going to be that way, because I mean that's in the past what I've been experienced. No, it was surprising the velocity in which the market fell. The VIX opened to a levels of more than 80. That was historical levels. It was never presented before. And on the other way around, when the Fed announced the liquidity support for all these corporates, first with the high rates and then with the high yields, it is impressive how the market really turned over. No? And it's, I mean, you can see it in the results. I mean, year to date, the total amount of issuance of the US corporates from January to today, it's even larger than all the issuance of 2019. So that really represents a huge difference of the support from the Fed. And that, as Carlos mentioned before, I mean, that spillover benefited the whole region in Latam, as you know. And almost immediately, I mean, you start the first issuer that put their feet wet was the government of Panama. That was almost like a month after the initial crisis started to printing in the markets. No, so basically that's it. I would say the velocity in which the market fell and the velocity in which the market recouped. No, I think it's the biggest difference from my past experience.
Thank you. Carlos, at the onset of the crisis, you would have had several deals in the pipeline. How did the clients that you were having discussions with, structuring the deals for, how did they react to what they were seeing, this free fall in the markets? What were their primary concerns, and how did you manage that discussion?
Thank you. I think in the month of March, we had already executed most of the sovereign, quasi-sovereign transactions that we have in the pipeline, because they typically come into market in January and February. So we're done out of that. We were executing all the corporate pipeline that we had. The difference, and I mentioned this before, the difference between these sovereigns and quasi-sovereigns and the corporates is that their leeway to access the market is longer. So it takes more time for them to execute. So they were still in the process of documentation when the crisis came. The decision at that time was to continue to work, but the main concerns that they had was about the funding costs they were going to get. Because the first thing that hit is when the crisis started to involve, the levels where they were going to be funding themselves increased significantly. So they were very concerned that if they were to go to market, beyond having access, right, they would have to pay a big premium for that. Yes. So most of them waited for some time to let the market react. And what we saw is, as Juan mentioned, is 4 weeks after the crisis hit their worst part, we started seeing again the pipeline building up from sovereigns and quasi-sovereigns. So the sovereign of Panama came to market. We had transactions for the Republic of Chile, we did Codelco. We did a bunch of transactions in that sector, and we were able to bring the pipeline up. We were not expecting this to be so fast, as Juan mentioned. We thought it's going to take many weeks or months for us to be able to bring transactions to the market again. But given all the policies that were taken in the US with the Federal Reserve and also with the international central banks, we were able to see that the investors started to feel comfortable again and to put the money to work. So I think that's basically what we saw in terms of the concerns of the issuers and how it affected the pipelines we were working.
Thank you. I'm sure that there were some, in terms of the sectors that we would have identified as being hardest hit. There'll be some, they will probably be facing different market conditions, different levels of reception. How do you think that during the crisis, the market reacted, say, an airline or somebody in transportation? How did the market react? Would the market have reacted to an entity such as that coming to market to raise funding? Carlos?
Right. So in terms of the access to industries that are more affected, so the best example that we have come from the US. We had airlines and we have cruise operators that maybe 3 or 4 weeks after the coronavirus started, they came to market and they were able to get the money that they needed to survive the crisis. An example is Caribbean Cruises. They came for a market for $1 billion to build the liquidity. They pay a steep coupon. It was 12%, but they were able to get to market. American Airlines also came to market to fund themselves, and we have seen them and continues to access to.
We seem to be having a little technical trouble with Carlos. Juan, are you hearing me? Carlos?
Yes, I'm here. Can you hear me?
Yes, go ahead.
Yes. Yeah. Sorry. Coming back to our region, right? What we saw is that the issuers in, let's say, in mining, which was also very affected with the coronavirus, given that the demand was expected to drop, right, and the prices of commodities came down, and in oil and gas, right, we were able to access the market. But the issuers that came to a market first on these industries were companies that were owned by the government. For example, on the mining space, right, we brought to market a transaction for Codelco, which is a copper company in Chile, and they raised a lot of money to be able to fund the liquidity needs that they have. In the oil and gas space, we were also to bring to market, as I mentioned before, Petrobras, which is an oil and gas company, but we also brought to market a transaction from Ecopetrol, which is an oil and gas company in Colombia. So I think that's a good reflection that these issuers have access, but what we have not seen yet is corporates in the mining or in the oil and gas space that are already entering the market. Now that the pipeline from West Story has slowed down a little bit, we'll start to see more corporates coming to market. And I think the market's going to be very interested in understanding the sustainability of their businesses, especially like if you think about oil and gas, they're going to check where the expectation of oil and gas prices compared to what's the cost of production. So it's going to be more on a base-to-base basis, but we have seen that some of these issuers, given they have strong bank relationship, they have also been able to fund themselves with bank financing, more thinking about a bridge financing than something else, something for the short term, and then thinking about taking those out in the future.
Okay. Thank you so much for that. My question would be, though, I mean, we saw where Carnival, as you would have mentioned, one of the companies in the leisure transportation business would have been able to secure financing just at the start of the crisis. But how would they fare now if they were to, if say Royal Caribbean were to come to market to seek funding?
I think it's a very good question. I think the access has changed a little bit. Many of these issuers before the crisis, they were able to fund themselves unsecured without any problems. Yeah. Now that the crisis has come, investors are looking more for collateral as backup to be able to support those issuances. So I think that there are arguments for them to come to market, but they were going to have to pay higher premiums than before, and they might have to concede on collateral and other debt reserve accounts and things like that that are not common in the market to be able to have the access that they need.
Thank you so much. I'm just wondering, though, in terms of how we expect the market to evolve and recover over the next couple of quarters, in terms of, you know, being faced with the higher premiums, when should we expect to return to a level where premiums are at a quote-unquote reasonable level?
Right. So I think we were talking more about earlier about the industries were very affected by the crisis directly. Yes. But other industries that are not so much affected or the impact is lower, let's say telecom or power utilities or some of the sovereigns, right? They have already started to trend down. Like if you look at the example of Jamaica, the 2028 bond that they have in dollars, before the crisis was trading around a yield of 3.9%, and it's currently trading at a yield of 4.05. So despite peaking 10.6%, so it increased basically 360 basis points, it has been able to recover and come down to levels more acceptable. So given that many of the issuers in other industries not so much affected, they're seeing that their funding costs have trended down, we will start to see them funding. I think that most of the people are concerned about the future for sure. We don't know if this is going to be something that's going to be here for 6, 12, or 18 months. So their recommendation that we have for them is that if you have access to the market, it's better that you pay a negative carry for that money and that you get funding long term, 5, 7, 10 years, and get the money in your balance sheet. And if you need it, you use it. And if not, you find a way to repay it in the future, right? Then wait until things get better and that you might not have access. So that's kind of be like the way we have advised clients, not only in Latin America and the Caribbean, but the US. That's why we have seen record issuance in the US from corporates and highly rated corporates and high yield issuers, because they're building their liquidity to make sure they are well covered for the things to come, which are still unknown.
Okay, thank you. Sarah, we want to bring into the discussion. I'd like to know, how will your approach change in light of what we've seen in the markets? What will be your new approach to advising your clients in this time?
So in terms of advising clients and an approach to pursuing mandates, I see there will be a lot more collaboration. So I, for one, am leveraging the partnerships that I have within Scotia, including the corporate bank. At the end of the day, I think that the capital markets, as well as the traditional institutional commercial banks, have served different objectives. And I think it's very important during this time that we look at comprehensive solutions. Clients are looking for what their options are on the different scenarios, right? The truth is there's still a lot of uncertainty. So I find that the approach now is really about being very proactive and engaging. As I mentioned, I think that there's going to be greater collaboration, not only with across corporate banking, but with arrangers, just a lot more engagement with investors as we try to galvanize investor appetite and really decipher where investor needs are. So, I'll give an example, where a client may come and may be thinking strategically about, let's say, an acquisition that may be well or more suited for a capital markets transaction. But if we think about what an acquisition may do, it may give rise to additional working capital needs. So that's where I think the approach to advising is going to be a lot more comprehensive, as opposed to just taking a purely transactional approach. We have to consider the different scenarios and consider long term.
Do you expect that this will be a lasting approach that you need to take? How persistent will this approach need to be?
I think it will really pay off. I think it's the growth alone that we see in capital markets. I think at the end of the day, you do have to be mindful of how, certainly locally, how aggressive it has been, and for certain types of structures. So I think that there is a bit of reset that does need to happen. Yeah. So I do see it as something that's long-term and sustainable, really, because I see it as ultimately value add for a client, and just augurs well for an overall stronger relationship, right? I think, we talk about partnering with clients, but as I said, I think now it really needs to mean something.
Yes. So on the issue of lasting legacies of the COVID-19 pandemic, this question is for Juan, and you may jump in as well, Sarah. What, if any, lasting legacies do you see from the COVID-19 pandemic on the capital markets? Sorry, you want to start?
Okay, I can start. In terms of lasting legacies, I did mention, and Carlos alluded it to as well, from an investor standpoint, there are going to be lessons learned, right, from this crisis. Certainly at the early onset, people would have been looking at their portfolios to assess relative risk. Maybe they had certain exposures as it relates to collateral or structurally some concerns. So I think certain lasting legacies could be that we see certain credit enhancements to structures that maybe did not exist before. Carlos mentioned things like a debt service reserve account or a sinking fund or just more collateral in terms of structure. As I said, investors will have lessons learned from this in terms of exposure. When I speak to investors, certainly in Jamaica, a lot of investors didn't realize the kind of indirect exposure they had to hospitality.
Yes.
Right? So obviously that's been a major sector where we've seen fallout. And for certain investors, they may not have had direct exposure to a hotel, but they're seeing the sort of contagion or the effect across their portfolio.
Thank you. Juan?
Yes, in respect to the DCM angle specifically, I mean, what we've seen is like obviously business travel has been stopped completely. And for example, we've continued doing roadshows, but every roadshow is through a Zoom meeting, through conference calls. And in a way, it's much more efficient because instead of staying the whole week traveling to the whole world, now basically you pack them up in 2 or 3 days and are more specific, and so you obviously have less risk because you are less time exposed into the market, no? But I think, I mean, it's hard to tell once we have a vaccine how things will operate. But as of now, I think these are like the classic consequences of specifically for DCM. No?
Thank you. And my final question is, from an issuer standpoint, Sarah, what do you think the preference will be in terms of, capital raising in the aftermath of the crisis? And from the investor standpoint, what are they likely to prefer? And is there a sweet spot between the two?
So post-crisis, I mean, I think the issuer preference, as Carlos mentioned, I think there will always be an appetite or a place for cap markets when issuers think about where they effectively raise capital. So the capital markets do serve you for longer tenors that maybe go beyond, the remits of banking. It does serve you to the extent you are looking for more flexible terms as it relates to amortization. So, I think that has really driven the preference there. I do find that in terms of maybe risk premium and pricing, it can be a little bit more expensive than maybe going a traditional bank route. But I do see the preference for cap markets continuing. As I said, interestingly, the data would suggest that there are new issuers coming to market, just even looking at COVID. So I think there's still a lot of energy and interest in this space. As I said, in terms of investors, right, and what they're looking for, again, investors are asking for a little bit more security, or if there's not security, I will see maybe a change being that issuers go out and get ratings, either a credit rating for themselves or rating the issue. We talked about our public market as well. I've seen investors demanding or requesting that perhaps instead of it staying as a private placement, that it become a public listing. Yeah. So I do think the sweet spot could be in and around there, right? Where you can galvanize and get the right appetite, but maybe have more public issues, maybe see more issues being rated, and perhaps depending on the industry of the issuer, seeing structures that are a little bit more secured.
Yeah. Thank you. Cyril, Carlos, and Juan, thank you for your insight. We'll now open the floor for questions from the audience. Just remember that to raise your questions or comments, you place them in the chat box. Make sure that the word everyone is selected at the drop down beside the to button. And in order to pose your question, you need to make sure that you're using the everyone option for the questions.
So, well, I think maybe that they had some pre-sent questions.
Yes, they were.
So if we want to maybe look at some of the questions that were pre-submitted, if you can put those up for us to see.
Okay, so our first question comes to us from Island Roots. Prior to COVID, Jamaica came through a period of growth not seen for almost 2 generations. A lot of this growth was financed through bonds on the capital markets, which were more flexible, aggressively priced, and less cumbersome than institutional term loans offered by commercial banks. Many of these focus on the servicing of interest only, with leniency in terms of repayment of principal, and often leaving large balloon payments for the middle or towards the end of the tenure of the project. How is the market seeing these instruments since COVID, in particular the postponement of principal repayments towards the latter half of the project life? Also, with the change brought by COVID, will institutional lending become more competitive, or will cap markets remain as attractive as before? Sarah, would you want to take that question for us?
Sure, I'll take that question since it has a bit of a local market element. So just because of COVID, I wouldn't say that the investor appetite towards postponement of principal or bullet or balloon structures have changed. When we look at who our institutional investors are, I mean, it's a diverse market. And, take, for example, insurance companies, they traditionally are looking for long-dated assets. They're not keen on amortization. So I don't see where, just because COVID has come, that these structures or appetite for these type of structures will change. So I think the market is still certainly there. I mentioned one of the key things that we saw was perhaps a bit of a slowdown in possible US dollar raises as a function of the regulatory environment. So, but we still are seeing where Jamaican dollars, there's robust and adequate liquidity. So a lot of it has to do with the actual fundamentals of the issuer and what the use of funds will support. So the short answer is that yes, there will be still appetite for these postponement of principal structures. In terms of whether institutional lending will become more competitive, I do want to keep striking the point that I think that there is a balance. It serves different objectives when we think about institutional lending being, from the banks versus cap markets. They serve different objectives for a client. And I think in terms of when issuers are thinking about their financing strategy and looking at appointing an advisor, they want to ensure that they pick an institution that can leverage both, right? Because there is value add for both.
Thank you, Sarah. How is liquidity affecting the capital raises? This appears to be a local question as well, locally focused. Do you want to take that one?
Sure. So there, as I mentioned, there's quite a significant amount of J-dollar liquidity still in the market. In terms of its impact on capital raises, I find that very obviously through the March to May quarter, we saw where there was a decline in terms of issued transactions. Largely, despite there being liquidity, investors are holding on to their cash. It's almost like both issuers as well as investors have the same modus operandi in terms of cash being king. They want to preserve this liquidity. Deployment of this liquidity will come subject to it being compelling. So investors want to know, Sarah, what, compel me with price, compel me with structure. There is a premium for my liquidity. There is a premium for this risk environment that we're in and this uncertainty. So liquidity is there. I don't think that's the challenge. A lot of it is striking the right balance between making it compelling enough for investors to want to part with that liquidity at this time.
Okay, thank you. Our next question is, we're switching gears to the broader region. I'll ask I'll ask Juan to take this one. How have central banks in Latin America managed liquidity, local currency liquidity? What have they done to ensure that the corporates are able to refinance and borrow more cash to tide them through this time?
Well, I think that I will obviously you can talk for banks or central banks of every region, but I think the two biggest one is Mexico. I see in general, what they did is they lowered the rates. Then also another thing that they done is provide liquidity to the banks in respect of the dollar funding. And the third one was basically on the corporate issuers. No? In respect of Brazil, basically the same thing. They lowered the rates. Also, they start buying corporate debt from issuers, and also they provide liquidity to the banks through a mechanism called letras financieras. So basically, with those three, they provided the liquidity to stand this crisis.
So essentially, their response would have been similar to what we'd have observed in the U.S. and in Europe.
Not as big, but yeah, basically the same response.
Well, thank you, Juan. Is there another question?
Yes, that one there.
So what do you believe is the outlook for the Latin Americans' recovery? Juan?
Yes.
Do you have a perspective?
I think, yes. I think overall in the market, what has happened in the region is that many of the companies draw the liquidity lines from banks. No, so what you see, I mean, and those liquidity lines were mainly 18 months to a 2 year space. So I think you're going to see a lot of those loans coming into the market for next year. I think that is going to be part of visions. But in general, I think in respect of the whole region, I think you have to be more specific because, for example, regions like Peru, like Colombia, like Brazil, they're more specific on the commodity, on the pricing of the commodities. Regions like in Mexico, it's more on the industrial side, no, on the export side. So it'll depend, region by region, country by country, how this will perform. But you'll see a variation in each country depending on their circle, on the cycle of their commodities or the production line.
Thank you, Juan. So, are there any more questions?
I think we received three questions coming, or two questions coming from our client JPS, just in terms of the impact on the yield curve. So what they wanted to understand was what is the impact on the risk premium in the capital markets, and what is the expected impact on the yield curve. So Carlos, I know we discussed this prior, so if you could give us just your views on the risk premium that we're seeing in the capital markets and its impact on yield curve.
Thank you, Sarah. So I think the easiest way to explain this is by looking at the sovereign curve of Jamaica. I think if you look at the 2028 bond for Jamaica, you will see the evolution of their yield since March until now. When we started the month of March, the yield of the 2028 bond for Jamaica was around 390, right? When the U.S. Treasury rate, which is seen as a risk-free rate, was at 105. That represents a premium of around 285 basis points. That's a risk premium of the Treasury rate versus what the sovereign was trading. On the worst part of the crisis, we saw the bonds for the trading around 7.6%. So that was an increase in the risk premium from 285 to 685. So that's a 400% increase in terms of risk premium. Nevertheless, as I mentioned before, things have stabilized a little bit. Investors now are not so concerned about investing in other higher yielding assets. So you have seen that the bonds have been trading down. Right now, the bonds for Jamaica are trading around 4.05%, when the US Treasury rates are at 0.45. That represents a risk premium of 360, right?
Yes.
What I find interesting now about this is that despite the underlying yield being very similar, before was 3.9 and now is 4.05, the components of that rate have varied a lot. And that has to do a lot with the implementation of a lot of policies by the US Federal Reserve to decrease the US Treasury rates. So in the past, the risk premium was around 285,
Yes.
and now we see it at 360. So for a similar type of yield, the increase in the risk premium for a country like Jamaica it has been 75 basis points. Nevertheless, from a Jamaica point of view, their cost of funds is very stable. But I think that represents a little bit how we see the risk premium compared to a risk-free rate like the Treasury rate.
We have one final question. How will COVID-19 impact generally investor behavior? And I'm throwing this out to the three panelists. How will there be any lasting impact, or will it just be a short-term impact? Final thoughts.
Carlos, you want to take that one?
Yeah, sure. So what we have seen, and this has been like the evolution of the investor during the crisis. The crisis hit, and they were at home saying, wow, what's going to happen? Let's be very conservative. Let's not put any money to work. And they were also very concerned about the withdrawal from their funds. So the first 2 weeks for the US market and the first 4 weeks for the Latin American markets, the market was on a standstill. When they realized that things were not as bad as they expected, we started seeing new issue supply again. And they started to support this new issue supply with investing in those transactions, both in the US investment grade, in the US high yield, and also in the emerging markets. What we have seen as a change, which as an investor, I don't think anything is permanent because they're always looking for ways to maximize their portfolio, but they're seeing a shift that I think is going to be something medium term, is that these big investors, they have funds in developed markets, they have in emerging markets, and they have in other areas. Given that what you see in terms of rates in Europe is almost negative, and what you see now in the dollar in the US market is basically close to zero rates, they're starting to shift the allocation of their investments to higher yielding assets. That's why we have seen inflows into the emerging markets, and we have seen some of the outflows in the IG and market for the US. So this is a change that we see, and I think it's something that's going to be for a while we see rates like this. But as we go through the cycle of rates and rates start to come up again, you might see some reversion of the initial allocations that they have.
Thank you, Carlos. There we have it, folks. Capital markets are still open for business. We have to get on to the matter of rebooting the global economy, our local economy, our regional economy. So we believe that the markets still have a very important role to play. And, we have seen where the sovereigns, the corporates are very much in this space and getting going in terms of activating their projects. Thank you. You can always reach out to us after this webinar if you would desire to have any further discussion on anything that we have discussed here. Thank you so much for your participation, and thank you, our panelists, Juan, Carlos, and Sarah.
Thank you
for joining us.
Thank you.